Welcome back. Well, 1 week into the job, President Trump's pick for the Federal Reserve, Stephen Miran, already making headlines, attending his first Fed meeting and pushing for a steeper rate cut than what we saw from Jay Powell. Treasury Secretary Scott Bessent with me here yesterday, praising Miran's early impact. I want to get your take on where we are with regard to economic growth.
The Federal Reserve has been too high for too long, and we're going into an easing cycle here. President Trump's pick for the Federal Reserve Board, Stephen Miran, Stephen has said more in a week than the Biden administration appointees have said during their entire tenure.
And joining me now is the man himself, Federal Reserve Governor Stephen Miran. Governor, great to see you. Congratulations to you.
Good morning. Thanks for having me back, Maria. It's great to see you.
You've said that current policy is too restrictive. There are risks potentially driving up unemployment. You've got colleagues on the Fed who are a little more cautious than that. Just yesterday, we heard from Bostic, a couple of others, who are waiting and want to see more developments before they agree to another rate cut. What do you think they're seeing that you're not?
So I think that there's a couple of things that they're seeing that I'm not necessarily seeing, or I don't think is necessarily likely to prevail in the data. First of all, I think a lot of folks are more concerned about tariffs driving inflation than I am. And while I've always allowed that was a possibility, I have not yet seen evidence that there are tariff-driven increases in inflation. And given the experience we had in 2018, 2019, I think the burden of proof is on the data, and the burden of proof is on the folks expecting that, rather than assuming that there's going to be these material increases ex ante. I think the other thing that I'm seeing that they're not seeing are the really very significant changes in population growth, right? We just experienced the largest population growth shock up and down in my lifetime in the last few years, and the speed and the size of the shock is huge. And I think it's incumbent upon us as policymakers to take it into account.
Well, tell me more about that. What is this shock that you're referring to?
Yeah, so as you know, the immigration policy was very different 12, 24, 36 months ago than it is now. And you had millions of people, basically entering the workforce and entering the economy, entering consumption as well. Right. And we all know that population growth can be a material driver of economic outcomes. And for many years before the pandemic, there had been conversations about, do declining birth rates in developed economies mean that the entire world is converging to Japanese level of interest rates? I think that those types of conversations and those types of forces are still extremely relevant. It just happens to be that we got distracted by some other stuff in the last few years. But I do think there are material consequences of the huge swings in population growth as a result of what were essentially open border policies last year to now what, in my view, is very likely negative net migration.
That's a great point. Immigration is a big part of this. And also a big part of it, Stephen, is AI. Right? I mean, are you expecting a lot of job losses from artificial intelligence? And what do you think that means in terms of new job creation?
Yeah, so look, AI is definitely something with a lot of power to drive the economy. However, I think as economists, we need to be a bit humble about having very precise expectations about something like artificial intelligence. There's economists who have made famous jokes in the past that, the internet or the computer would have as much effect as the fax machine. And obviously that didn't pan out to be the case. So I do think it's important for us to have a handle on, to know the limits of economists' knowledge in terms of predicting exactly what AI is going to do. So I'm absolutely open-minded to the fact that it may be a significant driver, but I think it's a bit difficult to quantify at the moment.
You've had a more bullish outlook on the macro story than some of your colleagues. How would you assess the economy today, Stephen? And what kind of a growth number are you expecting for 2025?
Sure. So, so I'm actually probably a little bit more sanguine on economic growth than many of my FOMC colleagues. And it's funny that I actually even have, lower rate expectations in spite of that. And lower rate, prescriptions in spite of that. And the reason is that the reasons why I'm optimistic on the economy expand the supply side of the economy. That means they push out potential output and actual output at the same time. And so when you think about things like the incentives for investment that are part of the tax bill that was recently, passed by the Congress and enacted into law by the president, and you look at at things like deregulation of the economy and deregulation of the energy industry and the financial industry, in my mind, these all push out the economy's potential. They push out the supply side. They allow the economy to produce more with the same amount of resources, or they increase the resources of capital stock and labor supply that are available. And when you push out the supply side at the same time, it doesn't have implications for monetary policy because the output gap gets left relatively unchanged.
Mm-hmm. And do you think that we will see a 3% growth number this year?
I don't think for this year that's quite likely because of the weakness in the first half of the year. As I said before, I'm optimistic for the second half of the year, and I think we've got a decent shot of a number like that for the second half of the year. And then going into next year, we may get numbers that are in that neighborhood as well. But for 2025, it's not likely to happen because of the weakness in the first half of the year.
Yeah, I mean, the Fed keeps talking about inflation as it relates to tariffs, and we haven't seen it, Stephen. So, these expectations and warnings about inflation still running hot to concerns about a weakening labor market. Tell me about the most important data points that you're looking at when deciding in terms of another rate cut.
So my view of rate cuts is driven by a couple things. One is that neutral rates have been driven down by things like the revenues from the tariffs that are pouring in. The Congressional Budget Office forecasted that we would be collecting almost $400 billion a year from tariffs, right? That's a material change in what economists would call the supply-demand balance for loanable funds, which means it pushes neutral rates down. Neutral rates are also pushed down by immigration, as we discussed before. And then there's also my expectation of declining core services inflation, driven by what I expect to be lower rent inflation in the future, lower shelter inflation, driven by a couple things. One, the period of catch-up from the pandemic surge in rents appears to me to be behind us, which means that I expect new rents which means that I expect that all tenant rents and the way that the inflation indices are calculated to catch down to market rents, which have been growing at a very low rate for the last year or so. Second is the immigration factor, right? When you start sending net migrants home, when you have negative net migration, it's a positive shock to the net supply of shelter. More people renting without a big adjustment to the housing supply pushes rents higher. And so my expectation for shelter inflation is that it actually starts to come down in the next 6 to 12 months. That's what I'm looking for to sort of. Yeah, that's what I'm looking for, and I think we have to be forward-looking in it, and that's why my prescription for rate cuts is more aggressive than some of my colleagues.
So shelter inflation coming down, that would be a big deal, obviously. Right now, ownership of a home has really gotten out of reach for so many people because of the level of mortgage rates. So let me get back to your expectation on rate cuts, because do you feel a certainty that as short-term rates go down and as the Fed cuts rates, that you will see that impacting mortgage rates? Because recently what we've seen is the opposite. Actually, long-term rates go up.
Yeah, well, I think that the long-term rate response to last week's cut has actually been relatively muted and reversed somewhat in the last couple of days. But I would expect mortgage rates to come down as the Fed continues cutting interest rates. I think that, the risk at hand is that, if I'm right, that population growth shocks due to changes in border policy are major drivers of things that go into monetary policy. And if I'm right that rent inflation is going to be coming down, and if I'm right that tariffs are not going to have a material increase on inflation, and to me, thus far, there's little evidence that that's the case. If I'm right about those things, then it's really important for monetary policy to exit the quite restrictive stance that it's in, because the longer it stays in that stance, the greater the risk to the economy that you do get a material downturn in the labor market that you don't need to experience.
So you wanted a 50 basis point cut. Instead, Jay Powell cut rates 25 basis points. What do you want to see from here, Stephen?
Well, my view, as I made clear in my dots in the summary of economic projections, is that policy is, I think, quite restrictive. It's 150 to 200 basis points too restrictive. And so my view is that it's better to get to that area quickly in a series of 50 basis point cuts, rather than say we're going to get there very slowly over the course of a year. Because, as I said a moment ago, the longer you stay that restrictive, the greater the risk to the economy that you really do start to get material increases in the unemployment rate. And so that's why it's so important to start adjusting more quickly rather than less quickly. When monetary policy is in that restrictive a stance, the economy becomes more vulnerable to downside shocks. And in my mind, there's not really a need to be running that type of risk.
So overall, we've seen this most recent 25 basis point cut. Do you want to see another 50 basis points? Do you want to see a total of 100 basis points? What would you like to see in the coming 6 months?
In the coming 6 months, I'd like to see us get a lot closer to neutral than we are now. My view is that we can get there in a very short series of 50 basis point cuts, readjust monetary policy, and then move more gingerly once we're there.
And do you feel that there's a feeling against a 50 basis points on the Fed board?
Yeah, I mean, very clearly from the outcome of last week's meeting, people don't feel the need to move urgently. And part of that is because they're still very scared of tariff inflation. But my perspective is that if I thought that tariffs were driving inflation, I would expect to see two things. One, I would expect to see import-intensive core goods inflating at much faster rates than domestically produced core goods. We don't see that in the data. And two, I would expect to see U.S. core goods inflation diverging in a very marked, very obvious sense from core goods inflation in the rest of the world. And again, we don't see that in the data. So in my mind, there has not yet been material evidence of tariff-driven inflation. And I think that's what's holding up a lot of my colleagues.
All right, we will keep watching that. Stephen, it's great to have you this morning. We'll be watching your work. Thank you, sir.
Thanks for having me. Good to see you.
All right, Fed Board Governor Stephen Miran.